All right, welcome back. So, if you're trying to make sense of the major market shifts we saw in early 2026, or maybe just wondering why everyone's suddenly obsessed with factory data from Vietnam, then you are in the right place. We're digging into research on what sources are calling the Great Rotation of global capital. And this isn't just, normal market churn. This is something much bigger.
It absolutely is. And I think our mission for this deep dive is to really get under the hood of what's happening. We're seeing trillions of dollars on the move. And it's not random. Money is leaving some of the biggest names in U.S. tech, and it's flowing with a very clear purpose into specific Asian markets. This is not a panic. It's a coordinated retreat.
Right, and the sources give us a real quantitative blueprint for this, don't they? This isn't just about sentiment. We're looking at two really hard data sets that are driving these decisions. First, the huge gap in price-to-earnings ratios, PE ratios. And second, these wildly different manufacturing PMI numbers from around the world.
Exactly. And understanding this is, well, it's vital, not just for fund managers, but for you if you're a CEO, a policymaker, an investor. Grasping why this capital is moving and where it's being treated best is really the key to figuring out where sustainable growth is going to come from.
Okay, so let's start with the first part of that, the great unwinding. The sources are really clear on this. The era of growth at any price is over. That whole idea that potential mattered more than actual profit, gone. So why the sudden exodus from U.S. tech?
Well, it really all boils down to simple math, the PE ratio, which is just the price of a stock divided by its annual earnings. You know, how many years of profit you're paying for today.
And the numbers we were seeing in late 2025 for some of these big AI and cloud firms were just
They were nuts.
they were totally disconnected from reality. You had PEs of 70, sometimes even over 100. And let's just pause on that for a second. A PE of 70 means you're betting a company will make what it's making now for 7 decades just for you to break even. That only makes sense if you assume growth is infinite and guaranteed. Yeah, that's a huge leap of faith. You're paying for all the potential success right at the start. And when you put that next to the valuations in Asia that the sources cite, the difference is just, it's absurd.
It's a completely different value proposition. The sources point to, say, a top-tier Indian engineering firm, which is central to their whole infrastructure boom, trading at a PE of 18.
18, okay.
Or a big Vietnamese logistics company, perfectly set up for the export boom, at a PE of 14.
So if you're a fund manager, that completely changes the risk-reward calculation.
It flips it on its head. You're thinking, okay, I can pay 70 times earnings for a U.S. company that might grow 30%.
Yeah.
Or I can pay 18 times for an Indian company that only needs to grow a steady 20% to give me a much better and, frankly, much safer return. Smart money isn't selling innovation. It's selling overvaluation.
But here's where it gets really interesting. It's not just the numbers. The sources point to a huge compounding factor here, which is regulatory risk.
Precisely. For years, the assumption was that big tech could just expand everywhere with no friction. That's just not true anymore. You have things like the EU's Digital Markets Act, you have ongoing antitrust stuff in the U.S. These are now material, quantifiable risks that go into the models.
And how does that actually hit the valuation?
It basically puts a cap on their total addressable market. If you're forced to share infrastructure, or you can't make certain acquisitions, well, you can't have the infinite blue sky growth you promised. And if you cap the ceiling, the price has to come down. It's as simple as that.
So what's the immediate lesson here for someone listening? Maybe someone in the startup world.
The model has to pivot immediately. For a decade, it was all about user acquisition. Get big fast, worry about profits later. That's obsolete now. The new money, the global money, it demands a profit-centric model. It wants to see strong unit economics, real cash flow. If you don't have a clear path to profitability, that well has run dry.
Okay, so that explains the why, the retreat from these overpriced stocks. But now for the where are these trillions actually landing? And for that, we have to turn to the second piece of data, the PMI, the Purchasing Managers Index.
Yeah, the PMI it's probably the most important real-time indicator there is. It's simple. Over 50 means expansion. Factories are busy, they're ordering more, hiring more. Below 50 is contraction. It's the pulse of the real physical economy.
And the numbers in late 2025 were like a giant flashing spike.
Oh, absolutely. The U.S. and Eurozone were just kind of treading water.
Yeah.
PMI is around 50.5, 49.8, stagnation. But the numbers from Asia were just staggering. India's manufacturing PMI shot up to 58.2.
Wow.
And Vietnam hit 57.5, an eye-watering number.
And what does a 58 PMI actually mean, like physically?
It means the factory floor is humming. It means managers are seeing a huge surge in new orders. They're ramping up production. They're hiring people. They're stocking up on raw materials because they expect this to continue. It was the clearest signal you could ask for. Stop betting on digital potential in the West and start betting on physical capacity in the East.
And the root cause for all this is that whole China plus one idea finally becoming, well, a reality, a corporate imperative.
Yes. The trade war and then COVID really exposed the massive risk of having all your supply chain eggs in one basket. So now de-risking is not optional. It's a survival strategy for these big multinationals. The capital is just following the factories.
So why India and Vietnam specifically? What's their edge?
They each have a different powerful appeal. India has that massive domestic market, so you're not just dependent on exports. It has a huge skilled labor force. And crucially, the government has been very consistent with things like the production-linked incentive schemes, the PLI schemes.
Right, they're actively courting these companies.
Exactly. They pulled in giants like Apple and Samsung by basically rewarding them for making things there.
And Vietnam's angle is a bit different.
Vietnam is just an export machine. They have incredible logistics, competitive costs, and a whole network of free trade agreements. That gives them really smooth, low-tariff access to markets in Europe and North America. They're built for global trade.
Which brings us to a pretty sobering point for you, the listener, and your local economy. The sources note that while you might be perfectly located geographically, your nation is sort of invisible on this new map.
Yeah, the hard truth is that this great rotation is just flying right overhead. The capital and the factories are going to India, they're going to Vietnam, and meanwhile, local industrial areas are still struggling with basic infrastructure. It's not that we're failing to compete with them, we're failing to even get into the game. We can push this analysis even deeper than just PE. We can use the tool that analysts really use to find value. It's called the PEG ratio, price earnings to growth.
Okay, so break that down for us. How is PEG different?
PE tells you if a stock is expensive now. PEG divides that PE by the company's projected growth rate. It tells you how much you're paying for each percentage point of growth. And the magic number is anything below 1. That means you're basically getting future growth at a discount. It's cheap growth.
So let's run those same companies through the PEG lens. This is really where the science comes in.
Okay, the U.S. tech giant, PE of 70, with maybe 25% growth, divide 70 by 25, you get a PEG of 2.8. Very expensive growth.
Right.
Now, the Indian conglomerate, PE of 18, 22% growth, that gives you a PEG of 0.82.
Under 1, cheap growth.
Exactly. And the Vietnamese firm, 14 PE, 20% growth, that's a fantastic 0.7 PEG.
So it's undeniable. It's not just about finding cheap stocks. It's about finding cheap growth.
And that's the framework that local investors need to adopt, whether you're looking at the NEPSE or anything else. You have to move beyond just asking, is the price going up, to what is the real verifiable growth, and am I paying a crazy price for it?
But the numbers alone, they don't move trillions of dollars unless there's trust. And that brings us to the big intangible, right? Policy credibility.
Yes. Global capital is, at its heart, a coward. It hates uncertainty more than anything. And what's so interesting is that India and Vietnam got rewarded for being consistent, even when governments changed. Vietnam's pro-export policies have been stable for decades. India has kept its core liberalization policies going through multiple administrations.
And that stability is worth actual money to a big fund.
It is. Because a CEO needs to know that the tax rules for the $100 million factory they build today will be the same in 5 years.
That consistency lowers the risk. It's a form of currency in itself.
Which really highlights the core problem your nation is facing, this chronic policy whiplash. Tax laws, FDI rules changing with every new cabinet. It's a massive drag.
It is. The real tax on investing locally isn't the corporate tax rate. It's the huge risk premium investors demand to cover that political instability. Until you can prove you offer policy credibility, the smart money is just going to keep its distance.
Okay, so let's wrap this up by looking at the two strategic paths forward for your nation over the next, say, 24 months. Because the choices made right now will decide everything.
The bull case, the optimistic one, requires radical action. And it has to start now with real results by the end of 2027. This isn't about small tweaks.
And what does radical action look like?
First, you need an all-party consensus on a modern Foreign Investment Act, a new FITA. Then you use that to build a real single-window system, one with a legally binding 90-day approval for any project over $1 million. Investors need speed. They need certainty.
And you have to pair that policy with actual physical infrastructure.
Mm.
The sources mention special economic zones, or SEZs.
Absolutely. You need one in the Terai with solid road and rail links to Indian ports and another near an international airport. And these can't just be zones in name. They need guaranteed uninterrupted power and pre-approved clearances. Islands of efficiency.
And if all that happens, what's the prize?
You capture the +2 or +3 business. You won't get the main iPhone assembly, but you can become the hub for high-value components, specialty pharma. You turn your location into an asset.
And the bear case is just more of the same.
The bear case is just continuing on the current path. If that happens, that window of opportunity slams shut by 2028. Supply chains are sticky. Once they're built elsewhere, they're not moving. And the nation just slides deeper into a remittance economy, exporting its young people to power the growth of its neighbors.
So what's the final hard truth in all of this?
The hard truth is that the biggest competitor isn't another country. It's our own institutional paralysis. Global capital doesn't grade on a curve. It is ruthlessly meritocratic. It goes where the risk is lowest and where credibility is highest. This great rotation is happening now, with or without us.
So to recap, to get that capital, you have to focus on low PEG ratios, not just high PE. You have to listen to what the PMI data is telling you about the real economy. And above all, you have to earn policy credibility.
The trillions of dollars out there, they don't owe anyone an investment.
Right. Our only choice is whether we build the landing strips for that capital or we just sit back and watch it fly right over our heads. Thank you for diving deep with us.